How to Manage Personal Finances book, Chapter 13 of Dog Groomer's Fortune and Mutual Fund Investing Options. This is Ken Boyd with the Accounting Accidentally Substack. And remember that I'm posting an entire text version of this book on Substack, video versions on a YouTube playlist, and you can email me for my fifth book's publication in late 24, early 25. So I think my dog groomer is making a fortune. The building is less than 1,000 square feet, and it is always busy. I've been taking dogs to this groomer for 20 years. I've never seen a slow day. There's always people there, and I think I know why. Customers know what they're getting. The staff is very clear about what they can do, and most importantly, what they can't do. If you think your dog is going to compete in the Westminster Dog Show, you should probably take Princess Caroline somewhere else. It's not what they do. Clarity. It's something that investors don't always have. Did you hear these comments during tax season? You need to open a retirement account so you can take the deduction on your tax return. Or do you have the 1099 for the dividend you were paid on the IBM stock? Completing your tax return is tough enough, and then tax preparers, investment advisors throw in additional questions revolving around taxation and investments. And mutual funds are particularly confusing. For example, what investments are in my mutual fund? Do I need to pay taxes each year? If I sell my fund, what's the tax impact? So to clear up these issues, I've used the box, the bag, and the wrapper analogy. Your Amazon shipment. Okay, let's assume you get a box from Amazon, and inside the box, there's 10 bags, and each bag has individually wrapped pieces of candy. Got it? So let's start with that analogy. The box is the type of investment account. The box specifically is the brokerage account that you use to purchase the mutual fund, and generally speaking, there are two types. Taxable account, interest on bonds, dividends on stock, and capital gains and losses are reported on your tax return each year, and you pay tax on them. In a retirement account, the most common retirement account you may be familiar with, a 401k through your employer, and you can set up other types of retirement accounts if you're self-employed. The tax impact of interest, dividends, and capital gains and losses is deferred. There's no tax impact until you withdraw funds at retirement, which is the point of a retirement plan, that we defer the taxation so you can accumulate more wealth. 401k accounts may also include contributions from your employer that are not taxed until retirement. Other retirement plans tax contributions before you invest. The mutual fund is the bag. So you got the box, and now it's the bag. Inside the box or the account, there may be one or more mutual fund investments. For example, Washington Mutual is a fund that invests in U.S. equities or common stock. To diversify the investment risk, your account may include different types of mutual funds, including a stock fund, a bond fund, or a balance fund that invests in both common stocks and bonds. And finally, the wrapper. Those are the investments inside the mutual fund. The bag, a mutual fund, may own dozens or even hundreds of individual stocks and bonds. Those are the candy wrappers in the bag. Washington Mutual, for example, owns dozens of stocks in a variety of industries. It's a big, well-known fund that's been around forever. As of this writing, the fund owns shares in 188 different stocks. If you Google and go to Washington Mutual and look at the holdings, it's 188 different stocks as of now. Clearing up confusion. So if your box is the taxable account, you can expect to receive tax documents that report interest income, dividend income, capital gains, and losses each year. If your box is a retirement account, the tax impact is deferred until you sell the investments. If your mutual fund buys and sells stock in a taxable account, there's a tax impact, gains and losses. If bond sales occur in a retirement plan, it doesn't affect your taxes until you withdraw funds at retirement. So keep this in mind as you start to invest. That's as far as we'll get right now. You can find all of the content on Substack and YouTube. Thanks for watching.